Ever thought about investing but don't know where to start? You're not alone. The world of investing is like a vast ocean, teeming with different opportunities and challenges. It can seem intimidating, even downright baffling, especially when you're just dipping your toes in for the first time. But here's the thing, it doesn't have to be. Now, you might be wondering, why should I even consider investing? Well, let's think about it. We all have financial goals. Maybe you're saving for a dream vacation, a new house, or perhaps you want to ensure a comfortable retirement. Whatever it is, investing can be a powerful tool to help you get there. Investing is, essentially, making your money work for you. It's like planting a seed and watching it grow into a tree. It's about taking a leap of faith with the hope and expectation that your investment will grow over time. This growth is what we call return on investment. It's the reward for taking a calculated risk. But let's be clear, investing isn't a get-rich-quick scheme. It's a journey, a long-term commitment that requires patience, discipline, and a pinch of courage. It's not always smooth sailing. There will be ups and downs, just like the tides of the sea. But remember, with every high tide, there's a low tide. And with every low tide, there's a high tide. That's the nature of investing. Now, it's also important to note that investing isn't for the faint of heart. It requires knowledge, understanding, and a well-thought-out plan. But don't worry, you don't have to be a Wall Street wizard to start investing. All you need is the right guidance, the willingness to learn, and the determination to stay the course. So, where does one begin this journey to financial growth? Let's find out. The first step to investing: understanding what you're investing for. This might sound simple, but it's a step that many overlook. Investing isn't a one-size-fits-all strategy. Your goals and aspirations are unique to you, and so should be your investment plan. Whether it's a dream home, a comfortable retirement, or simply the desire to grow your wealth, each requires a different approach. For instance, if you're saving for retirement, you might need to think long-term and be patient. On the other hand, if you're saving for a house, your strategy might involve more short-term investments. The key is setting clear, realistic goals. This means not only defining what you want to achieve, but also how much time you have to achieve it, and how much risk you're willing to take. Remember, a clear vision of your financial future is the best starting point. With your goals set, it's time to explore the investment landscape. Imagine you're on an adventurous expedition, with different terrains representing various types of investments. Each terrain has its own challenges and rewards, and choosing the right path depends on your risk tolerance and long-term objectives. First, we have the bustling cityscape of stocks. This is the high-paced world of buying and selling ownership shares in companies. Stocks can potentially offer high returns, but they also come with a significant level of risk. It's like climbing skyscrapers. The view from the top can be exhilarating, but the fall can be steep. Next, we come to the calm countryside of bonds. When you buy bonds, you're essentially lending money to an entity, like a corporation or government, that promises to pay you back with interest. Bonds are generally less volatile than stocks, but their returns are also typically lower. It's like a leisurely walk in the park, safer but less exciting. Now let's move to the bustling market of mutual funds. Here, you pool your money with other investors to buy a diversified mix of stocks, bonds, or other assets. It's like shopping in a bazaar. You get to pick and choose from a wide variety of items, spreading your risk and potential returns across a range of investments. Finally, we reach the solid ground of real estate. Investing in property can provide a steady income stream and potential appreciation over time. But it's not without its pitfalls, like maintenance costs and market fluctuations. Think of it like owning a house. It can be rewarding, but it also requires upkeep and patience. Each of these investment types comes with its own potential risks and rewards. It's important to balance your portfolio according to your individual financial goals and risk tolerance. Remember, there's no one-size-fits-all solution when it comes to investing. Armed with knowledge about different investment options, you're ready to take the next step. A financial plan is your roadmap to investment success. Picture yourself as the captain of a ship, navigating the vast sea of financial markets. Your financial plan is the compass guiding you towards your destination, your investment goals. Why is a well-structured financial plan so crucial? Think of it as the blueprint for your financial house. Without it, you're essentially building your wealth on shaky ground. A solid financial plan helps you allocate your resources effectively, ensuring that every dollar you invest is working towards your specific goals. You might wonder, how do I create this plan? First, take a comprehensive look at your financial situation. This includes your income, expenses, savings, and any debts. Understanding your current financial health is the cornerstone of a robust financial plan. Next, consider your risk tolerance. Are you comfortable putting your money into riskier, high-reward investments, or do you prefer safer, steady growth options? Your risk tolerance will significantly influence the type of investments you choose. Lastly, revisit your investment goals. Are you investing for a comfortable retirement, a dream vacation, or your child's college fund? The nature of your goals will shape your investment timeline and the amount you need to invest. So, start today. Pen down your financial situation, risk tolerance, and investment goals. Seek professional advice if needed. Remember, a good financial plan can be the difference between a successful investment journey and a rocky one. Now that you have a plan, it's time to make your first investment. Choosing the right investment is much like choosing the right path on a journey. It should align with your destination, in this case, your financial goals. Remember, investing isn't a one-size-fits-all proposition. What works for one person might not work for another. So, how do you choose? Well, firstly, it's essential to match your investments with your financial plan. If you're saving for a short-term goal, perhaps a conservative approach is best. But for long-term goals, like retirement, you might want to consider a more aggressive strategy. Think about it like a road trip. You wouldn't take the scenic route if you're in a rush, right? Similarly, you wouldn't take the highway if you're out for a leisurely drive. Next, diversification is key. Spread your investments across different asset classes to reduce risk. It's like having a well-balanced diet. You wouldn't just eat pizza every day, right? You need a mix of proteins, carbs, fruits, and veggies. In the same way, your investment portfolio should have a healthy mix of stocks, bonds, and perhaps a sprinkle of real estate or commodities. But remember, always do your research or seek advice from a financial advisor before making any investment decisions. Choosing the right investment is a crucial step towards achieving your financial goals. The right choices today can set you up for a successful financial future. So choose wisely and happy investing. Investing is not a set-it-and-forget-it activity. It requires regular review and adjustment. Now, you may be thinking, I've selected my investments, isn't that enough? Well, not exactly. The marketplace is a dynamic entity, constantly shifting and changing. What was a golden opportunity yesterday may not be so bright today. Therefore, it's important to keep an eye on your investments to ensure that they continue to serve your financial goals. Think of it like maintaining a car. You wouldn't drive off the lot and never check the oil or tire pressure, would you? In the same way, your investments need regular maintenance. This doesn't mean you need to obsess over every market fluctuation. Instead, it's about staying informed, understanding how changes in the market could impact your investments, and making adjustments as needed. And remember, review isn't just about market conditions, it's also about you. As your life changes, so too might your financial goals. Perhaps you've received a promotion and can invest more, or maybe you've had a child and need to start thinking about college savings. Regularly reviewing your investments allows you to adjust your strategy to align with these personal changes. But how often should you review? While there's no one-size-fits-all answer, a good rule of thumb is to check in on your investments at least once a quarter. This gives you a regular snapshot of your portfolio's health, while still providing enough distance to avoid knee-jerk reactions to short-term market volatility. In conclusion, regular reviews are a critical part of the investment process. They allow you to stay informed, react to market changes, and align your investments with your evolving financial goals. So don't just set your investments and forget them. Keep an eye on them, tweak them, nurture them, and watch them grow. Remember, investing is a journey. Regular reviews ensure you're on the right track toward your financial goals.